Good morning. Today is September 3rd, and we are going to go over the markets for you to prepare you for what's coming next. This is the MENT.com weekly market research video. Let's start off here with the ES chart, showing you that the markets have pulled back decisively off of this trend. We have the potential for a bit of a head and shoulders, inverted head and shoulders formation here. And this is what I want to highlight you to, the fact that we have a shoulder here, a head here, whoops, and another right shoulder here. We have the potential for a very solid move to the upside. We do have the potential also for weakness back down to this level, which I'd highlighted many months before. At this point, this level here, this 39.34 level, appears to be holding up quite well. And I believe what we're going to do is we are going to see a bit of a retrieve back up into these areas. Potentially another, let me draw a line here and try to get you an idea. Potentially another 6 to 7% higher, flagging out back into this trend over here. Maybe having this set up as a major bottom if we can get above this high over here, and maybe attempting to see the markets move a bit higher. The rotational modeling system has moved back into cautious trending right now because of this downward trend. We need to see how this plays out. I'm going to break this video up into different segments so you can see what's going on. We have the, this is the ES. Let's come over and take a look at the SPY real quick. You can see my chart is full of lines, but you can also see how I've drawn this out. Finding support, the predictive modeling system shows that we have a pretty good chance at another upside move here. This is a daily chart, so we need to be very aware of the support level, and you can see the support level right across these lows right over here is starting to become a fairly solid range where we need to see if the market holds or breaks below this range. You'll see this on the custom index charts as well. The markets appear to be really shifting, really just trying to find support. Longer term, I think the weekly charts on the rotational modeling system are still bullish. In fact, I know they are. And until we see that really change direction, we are trying to really hammer out a bottom here. We may see some sort of early capitulation next week with the markets really shifting gears, moving into a new trend. And I wanted to highlight this, the predictive modeling system here. This is the NASDAQ, or sorry, the ES. And you can see that the predictive modeling system, this is a weekly, this is adaptive learning, this is designed to predict what's likely to happen. And we have a very solid range. We've seen the low down here, just off of this low. We have some consolidation range in this area over the next week or two. We also have the potential for upward movement like this, potentially with the likelihood or potential lower range being right in this area. So over the next few weeks, we could see the U.S. markets move into somewhat of an upward recovery, possibly up to 4,300 again, possibly up to 4,400 on the ES. It's just going to be a matter of time right now. The likelihood of an upward move is there. And I believe crude oil, if I come back over here, will move to the downside. It is trying to break below this lower support level, and I think once it gets below this lower support level around 86.40, it's going to melt downward back down into these areas here, and I think this is going to become a very critical line for oil, in the sense that I think there's going to be a fairly sudden move, a deflationary move, which is going to, the Fed is moving towards trying to deflate the market right now. I think you're going to see oil start to collapse. I think you're going, and it's all hinging basically on the fact that we're having another event very similar to the original COVID. Europe's having energy crisis. The U.S. is deflating a bit. The housing market's deflating a bit. The Fed is making moves to deflate the market. I think the most logical conclusion here is that energy is going to deflate. It's going to move lower. We're going to see consumers pull away heading into Christmas. We're going to see the U.S. market move into somewhat of a Christmas rally phase, maybe towards January, February. We'll see something happen with regards to a change in trend. But I think we're shifting away from the trends that have been taking place. You can see this oil chart has already moved upward and rolled downward. So we're now at a point where this level becomes critical. And if it breaks this level, we're going to be possibly moving down into this $63, $64 area, which will be a big break in oil. It may spur some activity, consumer activity. Consumers are still very actively engaged in the U.S. market, not so much in foreign markets. Natural gas broke down a bit today. You can see this is again a daily chart. I'm going to come in here, go to weekly, and I'm going to try to highlight the fact that we've seen an excessive rally phase. We've now got a very solid engulfing bearish here. It looks like it's running out of steam. So you can see here kind of an A, B, C, D, and then we have an 1, 2, 3, 4, 5 rally phase here. I believe we're going to see this roll back downward as demand weakens and we move into weaker consumer demand. Europe's really in a point right now where they need to do something. They need to solve their problem. But I think this entire move, this entire COVID move, which was really started, as you see here, in the middle end of 2020 here and then accelerated in late 2021, I believe this move is over. And we're now shifting into a different market dynamic. So be aware that this is shifting as we speak. And if we get into gold, gold has recently come back down and retested these recent lows again. You can see we've apexed here. This is the apex pattern I showed you. September 6th through September 8th, likely to reach a major apex. It's very common to see some sort of a rotation like we saw here just before an apex. You saw we had it here before this big rally here. Well, here we have this quintuple bottom, let's call it, in gold. You can see the lows here, the low again here, the low here, the low here, the low here, and the low here. Likelihood right now, I think metals have washed out this low. I think they're going to start moving aggressively, and I believe metals are going to start moving to the upside aggressively here in early September. We can see the U.S. stock market and metals move higher. We saw the same thing happen here. Remember, here was the COVID lows. Then we had the election time frame right over here. Then we saw metals move considerably higher while the U.S. stock market was rallying higher. And this could be, again, some sort of a massive crisis event or some sort of a energy crisis event. Something is going to take place, in my opinion, which is going to cause metals to move higher again, retest these highs, and that means that gold could be on its way up to 2,300 or higher. Silver, on the other hand, is really undervalued. It's giving us a fantastic opportunity over here. You can see we've blown through these support levels. We've come down to, when it comes right down to it, we've come down to this lower support level and below down here. It's $18 for silver. This is pre-COVID levels. We could get a little bit of a washout here, but I'm telling you, I think that the metals are primed and ready to go off of this low to try to rally back up. And it's just going to be a matter of time, in my opinion. The Fed is trying to navigate a soft landing. I don't see it happening. I see credit and debt concerns taking place as the Fed continues to raise interest rates, and metals are washing out as the stock market moves lower. But ultimately, metals have done nothing but moved higher over and over again. And you can see that we've seen these huge rallies take place from 2004 to 2011. Again, we washed back out. We came down here, formed this nice solid base. We rallied up. We're very similar to kind of, I would say, right in this area. Flagging out. We've come back down. We're going to potentially flag out into a formation here and then break to the upside. And now, how would I see this as a break? Well, we've got these lows over here from these COVID lows, which were extreme lows, all the way over to here, potentially up and in a flag formation, kind of like that. So we need to see where this plays out and how this plays out. We need to see an acceleration of trend back to the upside for metals. I know many of you are holding and wishing and wanting metals to move higher. Nothing has really changed. What's happening is we're seeing kind of a wash out of metals, which performed quite well today. Gold was up $14, silver was up 26 cents. Gold was up 0.82, silver was up 1.47. I really think we're washing out. These are the extreme lows. If you have a chance to pick up some extra at these low levels for physical, probably a pretty good opportunity. Okay, next we're going to go into the custom indexes and market gauges. Good morning, traders. Today is September 3rd. Let's continue on with the market gauges for the MENT.com weekly market update. Currently, the S&P, NASDAQ, YM, Transportation, and SPY have all moved into bearish trending on a daily basis, moving us into a weaker short-term trend. Longer term, we're still bullish overall. I'm seeing this as general weakness in the U.S. markets trying to find support. The major indexes may continue to have some weakness into next week, but I really believe as we move into September and October, we're going to start to see some upward trend biasing, possibly moving a bit above the 4,300 to 4,400 level in the S&P or in the ES. That would be the 430 to 440 level in the SPY. And I think we're going to be moving potentially into an early stage Christmas rally over the next 30 to 60 days, possibly moving into a nice, solid, moderate rally phase through the end of this year. We're going to keep our stocks exactly where they are, our allocation levels exactly where they are right now. Metals, as I told you earlier, have come down and formed a quintuple bottom off of the 1700 level for gold. Silver's a little bit lower, near 18, just below $18 right now. Bonds are holding up okay. We need to watch our bond position. We might be moving this into a cash position depending on how things play out, but I believe the markets are shifting over the next 20 to 30 days. I wouldn't be surprised to see the Fed move in a much more cautious manner in terms of rate increases. But overall, we're holding up okay. We've weathered this out very well. We got out of our positions, if you followed my research, back in August of last year, of 2021. We started moving away. In fact, earlier than that, I was telling you to trail your stops higher and look to get out of this in an upward trend, giving you the opportunity to ride this move out very safely, which we did. Now we're not necessarily trying to pick a bottom, but it's showing signs that the market may have reached a intermediate bottom, maybe forming the start of a wave 5 higher. We'll have to see how this plays out. We're staying very cautious right now, properly hedged. Metals and the stock market should continue to try to move higher over the next couple of weeks and months. I believe that fear related to the European and Asian markets, COVID and debt concerns are going to play out. The U.S. market is still going to be a safe haven. We're seeing very strong U.S. dollar trending, and that's really where we're at. We've got this sideways rotation that's and you'll see these in the charts here moving forward. And then let's come over here to the, oops, wrong direction. Come over here to the September update. This is marked for Sunday, which I post everything up normally on Sunday. The NASDAQ is bearish. It's much weaker than the S&P or the Dow Jones Industrial Transportation Index or the SPY. You can see that all of these are mixed. Short-term bearish, long-term bullish. Gold is bearish. Silver is bearish, bearish, and oil is bearish, bullish. Long-term bullish, short-term bearish. Gold and silver are really trying to hammer out a bottom. This has all been through unwinding of capital. It's very common for gold and silver to move downward as the stock market moves down because selling pressure causes metals to weaken. What causes metals to really rally is fear. Notice that when the market bottoms in 2020 and even in 2009, that's when we started to see a real rally in metals. So once the U.S. market potentially bottoms or some contagion event takes place, then we'll see metals start to really accumulate. Still, it's a great time to be accumulating physical if you can. So we're going to be holding this position as we wait for the markets to move forward. Let's go through the charts. First up, we have the FANG index. FANG index is holding near this 618 level, trying to find support. Could find very strong support at this level or could break down. So we're at a kind of a wait and see mode here. You can see this downward trending channel. You can see this big break to the downside. You can see that we have a very clear ABC pattern here. This could form a very solid double bottom. Remember, we're back down over here at mid-2020 levels in the FANGs index. I'm going to show you some things very interesting as we move forward. So this has wiped out the entire 2020, end of 2020, 2021 rally phase. It's very, very likely that if this level holds, we could see some sort of a rally phase into the end of the year here, possibly topping out over in this area, back near these lows and highs, across this 200 area, before we start to see any real weakness. So we need to see how this plays out. The U.S. stock market index is doing the same thing, although you can see we have this higher low over here. So unlike the FANGs index, the U.S. stock market index has moved down into an ABC pattern very, very clearly, found support above the COVID highs. We're now in a mode where we could see kind of an inverted head and shoulders formation here. We need to see if this holds up. We're back into this channeling range, this mid-green channeling range. If we find support next week off of this low and start to rally back to the upside, we could be looking at a new wave 5 to the upside. It could be still a correction, an upward correction, meaning an ABC type of move, but this C type of move may carry us quite a bit higher into the end of the year, and it may be very surprising to see the accumulation that takes place as traders are trying to watch this move rally even higher. Remember, my cycle predictions indicated that the end of 2022, which we're well into, could prompt a major cycle bottom or cycle event. So we need to see how this plays out through the end of the year. Right now, it looks like because of the strength we're seeing with this higher low, I'm looking right now for strength to come into play as we move into a slight Christmas rally mode. Next, we have the Smart Cash Index. This is the global market index, and you can see that it's drawn off of this line. I extended it just for this chart. We have this tightening pennant formation, these double lows. We're actually at a new low right now. It is downward trending, but we need to see if this holds. We need to see if this breaks or holds and attempts to move to the upside at all. We're down in these extreme low areas. We're down back near support. Potential support. It's going to go one of two ways, ladies and gentlemen. It's either going to try to find some support and move into some sort of a late stage rally phase, or it's going to break downward hard to the downside. Next, we have the metals index, and here we have that quintuple bottom very, very clearly. You've got 1, 2, 3, 4, 5 lows down here near this let's call it 387 area. We got below it this week and came back up on Friday. You can see that we need to see how this plays out. This could be a very strong bottom. It has been a very strong bottom for metals in the past, but it's really at a do or die scenario here. Either metals are going to find some support, move to the upside, like the general markets I'm predicting, or we're going to see it really weaken here, at which point in time we'll get out of lessen our metals allocation because the fear factor here for metals is going to come into play at some point. We're just not seeing that real strength yet. This is really the unwinding. You can see through all of 2022. As the markets really unwinded and the Fed started raising rates, metals have pulled back. And this same type of thing happened. You remember back over here, 2018, we came back to as the Fed was raising rates. And then as the Fed loosened rates and became more accommodative, we saw metals really start to rally. That's what we're looking for here, is a change of stance in the Fed. If the Fed moves interest rates higher by 0.75%, it's going to be probably weaker for metals. If it moves rates 0.25% higher or 0.5% higher or takes a pause, then we could see metals really change direction. And remember, the Fed is paying attention to what's going on, and they really need to see a change in inflationary trends, which I think is happening in oil and natural gas and other commodities right now. Okay, the valuations index has moved broadly lower, back down into this weaker trending. We're getting very close to this red level, which I told you we need to see as a deflationary valuation cycle. We're down into pointing downward cycle trends again right now. We are possibly going to be trying to find some support in this area, but the next phase, if we lose support in this area, the next phase is just weaker and weaker downward trending, really moving us likely into a stronger recessionary trend. But valuations have diminished. I remember when I was doing this back over here through COVID, marking these highs and these pennant formations, and I was just surprised at how valuations stayed elevated. Well, at this point, we're back down into really 2017-18 kind of valuation levels at the highest valuation level for 2017, 18, 19, except when we got this breakout range right here, which was late stage 2019. At this point, we're unwinding everything. That's why I think the Fed may move into a more cautionary stance going forward. Okay, the commodity to gold index is doing the same thing, moving down into weaker and weaker trending. This is telling us, ladies and gentlemen, that we're into, I don't want to call it extreme weakness. Extreme weakness would be down here near these lows. But we're moving into a very contractionary phase, which is why I think the Fed may start to weaken their stance related to raising rates. We need to see how the economy plays out and how consumers play out. They're trying to navigate a soft landing while the congressional and our government officials continue to spend. So they do have room to raise rates a little bit more, but the markets are showing that they've moved away from this excessive valuation phase, this appreciation phase, which is inflationary, and now they're moving down into more moderate deflationary or disinflation, deflationary trends, and this is what the Fed wants to see. It wants to see us move into these more moderate downward trending phases. They do not want to see us collapse. Okay, the volatility index is still staying above the 8% or 8.0 level. This is still moderately bullish. We've seen a continued support level here. I'm going to warn you that we need to see this hold up at this level. We need to see some support level build here and possibly move into a type of a Christmas rally here through the end of the year, possibly getting up to 12, 13, 14. But this entire unwinding phase has not broken us into bearish trending yet. We've gotten close. We came close way back over here off of the last low, and it held up just barely. But as you can see, this level here, this 6.2 level, roughly 6.4 level, is kind of my line in the sand for what I would call bearish trending. But you can see we get a big breakdown. Yes, we're getting downward trending in a bullish phase. We've stayed in this bullish tightening phase, which is why I think we could see a fairly strong end of year Christmas rally, possibly pushing U.S. assets back up to near recent highs, or the these areas here, possibly up into 14, 14.5, maybe a little higher. We will see, okay? We've seen this nice little change in direction in the stochastics. We're starting to see some upward trending in RSI, but we're not seeing the breakdown, the actual breakdown take place, either in the rotational modeling system or through my other indexes. And there we are, the end of this. This was my wave count. Now let's come back over here to the other custom indexes. This is the volume ratio index. You can see we've got very weak volume this week. We don't have a lot of real upward trending, but we are still in an upward trend phase here as far as up volume versus down volume. We do not have this breakdown event like we saw in early 2022. This indicated a very strong breakdown in upward volume versus downward volume. We're just seeing a moderate complacency here, no real buying phase. Next couple weeks, we might see this rally back up 12, 13, 14 as buyers come back into the trend. The custom US to valuation trend index, I wanted to highlight two things here. We've established this low. This is a monthly chart. So we established this low back in July. This was our low here. We rallied back off of this phase. We pulled back in August. So here was, this was June, July. Now this is August. September's a little dot over here. But you can see here off of this high across this area where we find quite a bit of support. And then back over here, we retest the same support. I'm really believing that the U.S. market is trying to hold this support level, and this goes all the way back to 2013, and then across the 2015 areas, 2017 areas, and now back over here to 2022. I really believe that the markets are trying to hold this support level and trying to move into a rally phase, which may move us back up into these near extreme highs. So we may move back to the mid 2021 peaks, which could put us back at near recent highs. So think of that as February, March, April type high levels. But again, we need to see how this plays out. We don't have any real change in direction on RSI. Little bit of change in direction here on stochastics. We need to see this low hold. As long as this low holds, then we have a potential for upward trending, ladies and gentlemen. Next, we have the large cap index. The large cap index is showing the same type of scenario. You can see that the large cap index has perpetually moved higher off of the 2009 bottom. It's just continued to move higher. A little bit of weakness here in 2013 where the Fed was tightening. Again, weakness here in 2015-16 prior to the election. We had this topping pattern setting up over here, and we've broken downward. But now we've seen this rotation and trend. You've seen essentially some support setting up over here. There's a ton of money still being thrown around in the economy, and Biden has just pushed out another bill trying to give a break to students and to spark the economy. So understand that spending is going to drive potentially the economy higher. They're trying to keep this, essentially, I don't want to call it on training wheels anymore. This is almost like an ether high with the economy. But given three things, Christmas rally potential, the Fed potentially shifting gear and moving to a more moderate stance, and Washington still trying to spend money and spark a growth in the economy, we could very well see foreign money move into U.S. large cap, dividend, and value stocks to move this market higher over the next 5-6 months. So pay attention. It could turn into a very strong rally phase here. Okay, U.S. to global market index. U.S. is moving down. I've highlighted the potential for a kind of an inverted head and shoulders formation. The foreign market, global market index has moved back down to near recent lows. I'd highlighted these boxes a long time ago, showing you where I thought support would be for the global markets and where I thought support would be for the U.S. markets. My thinking was in the upper COVID range where we were at in the end of 2019 and through this election phase. You can see the U.S. markets held up above this area, and the global markets have moved decidedly down into these COVID lows. I think this is probably a fairly strong bottoming area for the global markets. We'll see how it plays out. Obviously, the energy concerns are are very unique. But we need to see how this plays out, and I think we could see some really strong trending in the U.S. market, maybe not the global markets. Next, we have the custom global asset index holding up in this sideways channel. We're not really seeing a whole lot of selling yet. And again, I would strongly support that these 2020 area, this low of the box here, needs to really hold up as support. If we get below this box area in the global asset index, then we could see continued downward trending. But right now, my indicators are saying that they're thinking, or I believe, that we have a very strong potential for upward trending going into a Christmas rally. So we're holding up very, very well right here, and we need to see that continue for it to move higher. You can see we've gotten extended lows down here. The RSI is moving strongly downward. This is an invert, so need you to understand that we had gotten very extended here. We've moved back down in the middle channeling area, kind of where we had been back over here, and a rally phase back to the upside may push us back up into the 30-20 area here. And that's the end of that. Okay, so now let's move to the TT scanner. TT scanner this week has got no new triggers. It's been like this for 3 weeks. We've got oil and energy, still the longs. This has been in for 29 weeks. It's been in for 33 weeks. We've got our stop level at 107.76. We're at 142.40. We have a stop level here on XLE at 65.32. And we are at 79.96. I had mentioned to you that oil could break down. So oil could move quite a bit lower if we see Europe and the rest of the world pull away from spending, or if winter becomes really curtails consumer spending and driving. But understand that right now we really have a wash of bearish triggers. So we're not seeing anything really new. Now we are seeing this change to bullish in healthcare. We are seeing this change to bullish here in industrial, Amex Industrial Select. We are seeing a change here in the banks, bullish, and we're seeing a bullish trend here in utilities. So it used to be all bullish. Now we're starting to see accumulation in consumer discretionary. We're seeing accumulation in global technology, and we're seeing accumulation in the QQQ Trust, as well as in home construction, which again could lead us to the potential for the Fed trying to navigate a softer landing if inflationary trends tend to be abating. So we're seeing right now Nugget, GDXJ, and GDX as bearish, staying multiple weeks in a trend, having decent profits. These are the profit percentages here, 28%, 16%, 14%. We have a fairly strong stop level here. Could break and change over the next couple of weeks, but we are not seeing any real growth sectors yet. Nothing has been popping up. Nothing is showing new bullish triggers, so we're basically in this same dichotomy. Energy tends to be moving higher on a weekly basis, and metals tend to be moving lower on a weekly basis. We are seeing some accumulation taking place. Okay, that's the end of this section. Next, we're going to go into real estate, and beyond that, we'll do a consolidation or kind of a conclusion phase for this. Good morning, traders. Again, today is September 3rd. I'm going over the extended hot lists, the value hot list, and the core inverted TT scanner hot list, as well as the U.S. real estate market conditions, the custom metrics that I produce every week when the data gets updated. Okay, so let's go over the U.S. stock market or the real estate. Real estate conditions have continued to weaken. We're not seeing big price reductions, which is this dark blue line here. But it is starting to move downward. So price listings are starting to move downward. Price reductions still make up a very large percent of the market. They ticked up a little bit last week, and that's important. We had a big move in price reductions going through the February, April, May, June timeframe. Then they kind of weakened off as everybody was trying to accumulate real estate, thinking the Fed was going to shift gears. Now they've started to tick back up. You can see active listing counts have started to move downward. That's the orange line here. Median days on market has moved positive and is kind of flatlining a little bit as we're waiting for the September Fed data and decision. And essentially, price reduced share, which is this light blue line here in the middle, has actually ticked up again last week as we saw new reductions come into play. Now, what we have here with regards to price reduction or dynamic price trend modeling, we have a real price factor has moved from climbing excessively in 2021. You can see this was from COVID lows. We started to really accelerate, and this was moving. I need you to understand this. This is moving. So here's 1 month, each increment here. So 2021, 2022, and they're going monthly all the way out here to 2022. So now in post-COVID, we saw price reductions in COVID. It took a really big hit, and they climbed here, as you can see, close to 20% a month, peaking out really back over here in early 2022. So here's the dynamics, the modeled market demand. Modeled market demand shows how consumers are spending the money trying to buy into houses as inflationary trends and price trends continue to roll. So you can see here in late 2021, we had a huge influx of buying activity while prices continued to move higher. These were people trying to take advantage of the shift before the Fed started raising interest rates. Now, model market demand is weaker and is trying to move a little bit higher off of the expectation that the Fed would shift. Then came the news last Friday that the Fed was not going to shift, and this data hasn't been baked into these numbers yet. I'm expecting this move to really send a downward price trend to the modeled market demand and for price factor. Price factor, you can see, has started moving down 8 to 10% per month, or roughly per month for a continued basis. We went from plus 40% now down to minus 40% on a pricing factor. The real price factor is at minus 31.84, and the real price modeled market demand is at minus 47.45. That tells you that there is very little demand and very little price appreciation taking place in the U.S. real estate market right now, and I believe these numbers are going to move quite a bit lower as the Fed decides in early September what they're going to do. Now, the next one we want to look at is here it is, the price trends. And this is the more generic, longer-term modeling system. So you can see here that U.S. price trends, as per Realtor.com, have flattened out considerably. They're actually in a negative 4 to 5% range right now. U.S. real estate, let me move this over here. So they've ticked up a little bit here off of the Fed expectations of a Fed pivot, but it's very, very likely we could see some very big decline in pricing take place as we see what the Fed does. The Fed moving rates above 6% or 6.25% for a mortgage rate, which would be about a 3 to 3.5% Fed funds rate, could really put a dent in the U.S. market. You can see that active listings have collapsed. I mean, they've literally collapsed to below COVID levels. Real estate price reduction activity, actually price reductions have collapsed, so we're not seeing a huge amount of price reductions, but the reduced share of market is very, very close to, I would say, like 75, 80%. So price reductions are still excessive, although they're not rising right now. They will start to rise if we start to see the Fed really raise interest rates. So we need to see how this plays out. It's almost like a waiting game right now. And then, of course, the new listing count metrics we have here. New counts have moved lower, kind of flatline. New listing count change has continued to move lower, and new listing count share of market, you can see here, that's this gray line, has stayed somewhat flat, a little bit move up here in 2020. Then we saw it elevate here, and now it's pretty well flat. So new listings count share of market has moved lower. It's very hard to see. I'll have to probably move that into another chart here. But more importantly, I need you to see here that new listings count, this was a share of homes that have come on the market trying to sell out before the Fed raises rates. So even though they tell you that new listing counts are just not there, you can see active listings have come down. But in reality, new listing counts are still quite high. So we've got, from compared to where we were a year ago, in July 2021, we were at minus 40%. Now we're upwards at plus 23%. So we've seen a 60% increase in listings. And depending on what the Fed does, it's going to make for some very interesting dynamics going into the end of the year. Okay, so now let's come over to the core inverted hot list. Core inverted hot list is our alternate inverted list of symbols that we have options to trade. We had a flat signal here in biotech bearish, meaning that the biotech sector may be moving into a new upward trend or trying to bottom. We have DRIP, natural gas bear, has got a short signal that is a new signal. So this is a bear 2x on gas exploration and production. This showing you that we have a new short signal here, betting that this bear 2x signal may move downward. This is a bearish market, meaning that it is expecting oil to potentially move higher, this section to move higher, oil and gas production. We have a flat signal here in bear, high beta bear 3x S&P 500. So we're out of that trade. And we have a long signal here that's 19 weeks old in ProShares MSCI emerging markets. So it looks like emerging markets are up 11% with the first target hit. Stop is at 1352. It's currently trading at 1530. And we have no other signals going on here. Next, we have the core, the TT Scanner core hot list. TT Scanner core hot list has one new trigger here, UGL. UGL is the ProShares Ultra Gold. It is a short trigger. It is a new trigger. We have not hit targets yet. Otherwise, we have the same old triggers as last time. We are short ARKW, the internet sector. We've been in that trade for 17 weeks. We've got 21% profit in the trade. We have not hit our targets. We are long the XLE for 33 weeks. We are 30% in the profit, and we have already hit 2 targets. Remember, the targets here recommend that you take 30% off on the first, potentially 50% off on the second. You can switch those around depending on how aggressive you want to be. The idea is when we hit a first target or a second target, you want to lock in profits, and then you want to let a small position ride with the trailing stop, looking for an exit trigger. We are long 71 weeks into agriculture. This is a commodities, DBA. We've got 16% profit. We are very close to getting stopped out. We're only about 70 cents away from getting stopped out. We've already hit both of our targets. We are short the alternative harvest, the marijuana sector. We've already hit 1 target. We're looking at a second target at 409. We've got 27% profit in the trade. Our stop is at 704. XOP, we are long. We've already been long for 29 weeks. We got 28.79% profit, hit both of our targets. Our stop is at 107. It's trading at 142 right now. Gold, GDX, we are short. It looks like 8 weeks at 14% profit in the trade. We have not hit any targets. Stop is at 28.72. UUP, dollar, we are long for 20 weeks. We have a 9.96% profit in the trade. We've hit both targets. Our stop is at 26.62, currently at 29.38. So there's about a 4%, 4.5% stop there. We'll see how the dollar holds up. Dollar's been trending higher quite a bit. And looks like I have UUP in here twice. I'll have to go fix that. Okay, next we have the value, which I think I've already covered. Maybe not. Let's go through this. Kind of hard to see, so I'm going to zoom in a little bit. And let's move this over here and shrink this a little bit. So we have Chevron Corp, a long trigger, 34 weeks into the trade, 34% profit. We've hit both of our targets, and our stop is at 116.19. Next, we have, where was I? I was on the wrong one? I guess I was on the wrong one. So here's the value. Yep, let me do that again. So we have a new trigger in UNH right here. Two new, these are not new, they've been around for a while. UNH and CVX, that's Chevron Corp. So we have a stop at 116.19 for Chevron and a stop at 358.77 for UNH, which is United Healthcare Group. We've been in this trade for 71.33 weeks. These are both long-term trades. We've hit both of our targets. We've got 41% profit and 39% profit. We've got short trades here in Intel and Verizon. Or yes, short trades here. Verizon's only 2 weeks old. We've got 3.78% profit in the trade, have not hit our targets. With Intel, we are short for, looks like 8 weeks. We've got 14.18% profit. We've hit our first target. We're looking at our second target at 29.90, and our stop is at 37.06. We are short SMG, Scott's Miracle-Gro. Been in this trade for 19 weeks, 34% profit. We've hit both targets. Our stop is at 90.55. It last traded at 72.62. We have a new flat trigger here in Hasbro. So we will be closing any positions we had there. And that is it, ladies and gentlemen. That's everything in the value list. Now, the value list, the importance of the value list is that we look for opportunities in the strongest trending sectors. So how would we look for this? What I would do is if we don't have any new triggers, I go up to the strongest bullish and bearish trend cycle here, 5, 5, 4, 4, 4, 3, 3, 3, all the way down here into twos. So we have this entire list here. Smuckers, Black Hills Corp, Honeywell, Cummins, Edison International, Calavo Growers, Principal Financial Group, Goldman Sachs Group, Apple. These are all in the threes or higher. They're trending bullish. We basically could look at these as opportunity, and what I would like to see over here in this side, in the win rate and the profit factor, is I look for fairly low profit factor numbers just below 1. So hypothetically somewhere in the 70s or 85, maybe this 109 here. And then I would look for blue or green trending here, staying away from purples until it moves into blue or green. So that means I would be looking at potentially, this is red, so I'd be looking at maybe this first one, this second one, this 4703. In fact, let me zoom it out. So SMJ looks like a good trigger. BKH looks like a good trigger. This one here, which is Apple, looks like a pretty solid trigger. And AEP, American Electric Power Company, may be a fairly solid trigger. The idea is the value TT scanner list provides you an opportunity to look for opportunities when the major markets are, and major trends like the S&P and the NASDAQ are moving lower. This gives you an alternate opportunity to be able to trade into dividend and value stocks, which typically perform fairly well during a recession. You can see we've got a number of bullish triggers here, which we don't have in the other sectors. So again, we're not getting a whole lot of new triggers yet, but we need to just play it safe, stay mostly in cash, and protect ourselves with hedging. All right, we'll talk to you soon with the conclusion.